I'm not going to say that the Fed has lost the confidence of the markets or that they're irrelevant. They are. They matter a lot. But I would say this. Every single piece of note I read from Wall Street suggests that the bond market has already basically done the work of the Fed, that whatever the Fed does is in the rearview mirror because bonds and rates moving to where they are is really that part of the market just cutting in line of the Federal Reserve. What is your take on the Fed, inflation, and rates?
Yeah, I think what's happened is the bond market has priced in a very aggressive Fed, and the stock market has priced in a Fed that'll get more dovish and pivot once we start to see some of the ramifications of rate hikes. And so I think, as you alluded to, the Fed's in a really tight position because on one hand, you have real wages are negative, which is to say that, you know, if wages are going up by 5% and inflation is 8%, workers are taking a 3% haircut. And on the other hand, you have an economy that will start to slow. And you also have disinflation, which means that we'll have inflation. It just won't grow at the same rate. An example would be for oil to remain inflationary, oil prices, oil per barrel about to be $144 a barrel. And all this is happening in the backdrop of a midterm election that's coming in 6 months. So the Fed is really in a tight spot. And I think we'll start to see this manifest itself in the stock market as it resolves which direction they're gonna go, with or without all the very hawkish rhetoric that we're seeing out of the Fed.
Yeah, and I don't want to be too tough on the Fed, but I feel like it's like the Fed kicked the gate open, all the hogs ran out, you know, in inflation, and now they're kind of scrambling around trying to, you know, round up all these hogs and throw them back in the pen. In other words, they've lost control, putting it more bluntly. Do you feel that way? I mean, has the Fed, I don't want to say lost confidence, lost control? How do you view it?
Yeah, I think it's a dollar late, a day late, a dollar short. They thought that inflation was transitory. It was not. And so here they are now trying to clean everything up. Even when inflation now it's already happened, right? An example would be the Manheim Index. So used car prices are actually starting to come down. Oil prices won't keep going up at the same rate. So now we've got disinflation, and now he's raising rates into an economy that's going to slow. An example, we've talked a lot about the $1.3 trillion in stimulus money that's gone away. That's 6% of our economy. But, you know, there's also this narrative that Americans have all this money saved and because of COVID. Well, dollar savings, not savings rate, but dollar savings is lower than it was pre-pandemic. Anybody who would have got a tax refund, they've already received it. So all of the stimulus and all of the
already spent it, Ivory.
It's already spent. And now it's starting to manifest itself in earnings. So now earnings are beating expectations. But so far, I think 67 companies have reported out of the S&P 500. Earnings year over year are down over 7%. So now you're seeing this an earnings slowdown. You're going to start to see this economic slowdown as the Fed starts to raise rates.
Very quickly, are we pricing in a recession?
I don't think the recession is priced in if you look at stock prices. But I will say this. If you look at the S&P 500 down about 7 or 8%, that's a lot better than the NASDAQ, which is down, 16, 17%. That's because inside the S&P, you have defensive positions like utilities, real estate investment trust, consumer staples. Those are defensive stocks. Yeah. So people will pay their light bill. They'll buy a toothpaste, but they may not go on vacation. So the stock market is showing you that we're going to have an economic slowdown. If it turns into a recession, we don't know that yet.